tariff wars that Trump initiated have been certainly negative for all global economies, that can be said. It's also negative for globalization. We're talking about more isolationist policies coming through, but it's absolutely terrible in our opinion for the US economy in particular. Nothing has gone the way that I think Trump would have anticipated. Equity markets have fallen, the bond yields have gone up and not down, which is what he was hoping for. And in addition, the US dollar actually fell during this turbulent period and didn't go up, which it normally does. So all these are kind of signs that the markets aren't happy with the way this is all panning out. And a big part of the problem as well is the way it was rolled out. There's a lot of uncertainty, not just in equity markets, but also we would imagine with a lot of the companies. If Trump's intention was to bring all these companies into the US and bring all their factories and investments into the US for the longer term, I think it probably had the opposite effect, because a lot of CEOs are probably thinking, there's no certainty here. We can't invest behind this uncertainty. So I think the scorecard pretty much tells us that it was a badly executed strategy on Trump administration's part. What's more interesting, I think, is what comes next as well. So we've seen some of the effects on the market so far, but there's probably secondary effects coming. That is the consumer being affected by increasing inflationary expectations with goods going up. And we're already seeing signs of that. But that is to come over the next 3, 6, 9 months. So what that does for the Fed's ability to cut rates and how much they'll be able to cut rates to stimulate the economy, and what that does to the bond yields going forward. So these are all and for the economy overall, we might actually see a recession if we're not already in one in the US. So these are all secondary real effects that are about to come into play, and that will have further negative impacts on the US economy and US stock prices. So the way the markets voted is to shift some of their investments over to markets like Europe and China. And we've been saying this for 4, 5, 6 months now, that this is a real possibility and it's happening. The reason it's happening is because these economies, Europe and China namely, they have decided to stimulate their domestic economies through fiscal stimulus, monetary stimulus, and that is a very positive thing in the face of all this uncertainty, whereas the US is doing the opposite in effect. So we feel more comfortable investing in those regions over the next year or two, given all that's happening with the tariff wars. So what does this mean in terms of investing? It's a big world out there, and it doesn't mean that just because the US is doing all these things and it is affecting global trade, doesn't mean that there's no places to invest. We've got about 40 to 50% invested in European and Chinese equities, and within that, quite a few of our investments are focused on domestic consumption, or in many cases, companies that aren't really affected by the tariff impacts. So within China, for example, we decided a while back to focus on the Chinese consumer. It was clear that the Chinese authorities would focus on that aspect and they would stimulate consumption. So we have sporting apparel retailer, we have white goods retailer, and we also own the exchange in Hong Kong. So whereas in Europe, for example, we focused on companies, on one part industrial companies, because we do think, and construction related companies, because we do think the way the Europeans will respond is through stimulating their economies by building things, and that's coming through. And they're the kind of companies we're investing in. It must be said that when we're buying these businesses, we're not actually compromising in terms of quality. These companies in Europe and China have excellent track records. They've been around for a long time, and they've been growing for a long time, and comparable to any US company we're talking about here. But what's most important is in many of these cases, they are significantly cheaper. So we're paying approximately 40% lower valuations than an equivalent company in the US. This is why we still think the US has quite a long way to go to catch up. Either the Europeans and the Chinese companies go up and catch up with the US, but what's more likely is for them, those two economies, those three regions to meet somewhere in the middle. US going down, Europe and China going up in the meantime. So that is what's exciting us at the moment. In terms of technology, we're still enthusiastic about the AI chip trade. We still think that hasn't that investment cycle hasn't finished yet, and there's still more to go. But we're a little bit more cautious than we were maybe a year ago. But still significant position there as well. In terms of FX and currencies, we've been watching the Aussie dollar, and we anticipated that it would drop to the 60 level, 59 level, which it did. But at this stage, we see some real headwinds for the US economy, and we anticipate a lot of pressure on the US dollar, because as these countries like China and Europe, as they trade less goods with the US, we anticipate less demand for their currency, but also for their bonds, and we think the US dollar is under threat. And this is probably for the first time that I've seen in a long, long time that people are questioning the US dollar dominance in global trade. And when we think the euro, the Swiss franc, and even the Aussie dollar might see a period of prolonged strength here following these events. Of course, if Trump decides to take off all the tariffs that he's put in place, things might look different. But at this stage, that can't be the going assumption. We're thinking this continues, and this will continue as it is. US dollar weakens, other currencies strengthen.